slides.
Bear with me. There we go. There we go. If John's our tech director, I often say this at the beginning of these webinars. We have begun our broadcast, and just a few minutes to say hello and meet Deb and Paul before we begin our formal program. So we're delighted to have two new speakers to our programs, but people we've known for a couple of years now and are involved in some of Uri's programs, Deborah Vries and Paul Gregory, both from Anchin. Anchin's a CPA advisory firm, New York based, and we're looking forward to our program with you guys, Deb and Paul.
We're looking forward to it as well. Thank you.
Great to be here,
Well,
guys.
our pleasure. Our pleasure. And we're getting a slight late start. Normally we banter, talk a little bit about the weather. Needless to say, it's cold, damp, rainy, depressing in New York, and it's beautiful, sunny, and tax-free here in the Sunshine State. I just throw that out there for starters, since we're going to be talking a little bit about taxes and stuff like that as we approach year end. So Uri, my partner in crime, webinar number 63. How the hell are you?
I am great, John. Can't believe it's 63, but we're going strong. I'm looking forward to around 100.
We talked about that this morning, that we're going to run to 100, and you and I will probably be on crutches, and you know, but we'll keep cranking along as long as people enjoy these and we get the good positive feedback we get time after time. Our guests, we met them briefly as we were setting up. Deborah Vries. Deb runs co-leader of the law firm group at Anchin, and she also co-leads their compensation and benefits group at Anchin. So Deb, tell us a little bit about you, your background, and about Anchin and what it does.
Sure. So I'm Deb Vries. I'm an assurance partner with Anchin. I've been with the firm for 30 years. Actually, tomorrow will be the official 30-year anniversary. Anchin is a 600-person firm. We have over 60 partners, and we're a partner-owned firm serving the middle market in all industries. But I do spend almost 100% of my time working with law firms, like all the law firms that are on the line with us today. And since I'm on the attest side, from a compliance perspective, it's all about accounting, financial statements, whether you need an audit or review or a compiled financial statements, a lot of times in accordance with a bank agreement that requires that type of thing. And then I spend the rest of my time really consulting with my clients, talking about a lot of the things that we'll be talking about today.
And so, Deb, 30 years with the firm. Congratulations. And I guess you started as a 7-8-year-old?
I sure did.
You were fast tracked. and Paul Gregory. Paul, how are you? We've met a couple of years back through some of Uri's programs up in New York. Tell us what you do at Anchin.
Yep, great. Thanks, John. Thanks, Uri. First of all, thanks for hosting this webinar. Super excited to not only attend it, but to be a panelist on here. Happy to be all with you this afternoon. Like John said, I'm Paul Gregory. I'm a tax principal in Anchin's professional services group, where I spend the majority of my time servicing law firms, tax planning, and tax consulting, all middle market, firms. I work alongside with Deb on the attest team. I'm strictly on the tax side, planning, compliance, and advisory. And just looking forward to some spirited discussions today. I know we've got a lot to talk about, and my hope is that we all take something away from this with some discussion points, some action items, and potentially some more additional questions.
You know, Uri and I, as we plan these things, it's like fitting 30 pounds worth of material into the 5-pound sack. There's so much, and you get into these conversations, and we could have gone on all afternoon. The depth, the richness, these are great. And as Paul suggests, just come out with 1 or 2 takeaways based on the conversation, and we're all available to talk to you after the event, and we'll present our contact information. So hopefully this is the beginning of a dialogue. And Deb, we're happy to have you, and Paul, we're happy to have you too, I guess.
Well, John, I just want to mention one item. I want to step over a second. I too am celebrating my 30th year at Anchin tomorrow.
Wow.
Yeah,
Uri, we should buy him a cake or something, right?
30's a big number in today's world, guys. Congratulations.
And we're not the anomaly in the firm. We are
So
quite
we
the,
did earlier the year, we did a program with NALP, and they looked at the class of 2021 coming out of
Mhm.
law school. Class
Oh
of
my gosh.
2021. Guess how many jobs they have had after 4 years removed from law school
yeah, I think
graduation
I saw
on
this.
average?
I think it was like 3 or
Two and a
4.
half.
2.5. Yeah, it's
Two and a
crazy.
half.
Nope, it's
And
a
you
whole
guys,
different
30
world now.
years.
30 years.
We don't like
Loyalty.
change. We went into the accounting profession for a reason. Very
That
conservative.
loyalty that once was a lot of free agents, and the transfer portal is alive and well.
I think our managing partner and our associate managing partner are probably 33, right, Deb? They're 33 years.
33 and
So
34.
yeah. So
Really? Wow.
yeah.
That's great to see
Yep.
that young leadership,
Yep.
because they're
Yep.
going to be around a lot longer than us. A couple of shameless plugs, then we'll jump in. Our webinar series, number 63, we'll do one more in December. It's our year end. Uri and I have fun doing this, and kind of year in review, and we offer our big, bold, obnoxious predictions for the next year. And so that's always a fun program, and it's one of our most popular. We're trying to, help firms mid-size get into this AI. It's here, it's not going away, and the guidance around policy and training, and we're experimenting and building an AI community of managing partners. Beyond that, my colleague is Tony DeSimone, and we're doing sort of a standalone special webinar, kind of an introduction to generative AI, what managing partners of all stripes, not managing partners, anyone in the legal profession, including support staff and administrative team, should know. Practical guidance to use these new tools responsibly, ethically. We're going to get some CLE credit for this program and put it out there on December 4th. So you'll be hearing
John, how's
about
that group? How's that group going, John?
Our AI community, we have a community of managing partners. We put that out there about a year ago, and we have about 50 managing partners. It's very immersive. The people who are in it are really engaged, but it has been a slow build. I think a slower build than it should be for law firms to get in front of this and start using it, get ahead of the pack, because it ain't going away. And if you're the last firm on the block to integrate AI into your practice, good luck with that. So, it's a slow build. Like Uri, we talk about this, trying to build managing communities of busy people is you got to have some darn good content, and it better be entertaining. So thank you for asking. Our leadership conference, we're going to open the doors to register before year end. And Paul's going to talk to you about why, from a tax perspective, you should register before the end of the year. And we'll give you a discount if you sign up early. So we're going to do a soft opening. We get our weekly and other things out there to help managing partners. That's our AI community. And so today's program, our setup, and then we'll get kicked off. We have about 80 managing partners, firm leaders registered for today's session from all of the United States, Canada. Some of the stuff we were talking about is New York specific, some of it, and we mentioned to Deb and Paul to keep in mind that we are dealing with a national audience. We may have a smattering of Canadian firms in here too, dealing with a completely different tax structure. We'll do the polling. We always do record, and our ask of you is feedback. Tell us what you like, what you don't like, fuel for future programs. We really do take it in, and just takes you a couple of seconds to click here and answer just 4 simple questions. So we appreciate the feedback we get. Uri, we pay attention to it, don't we? We're just not talking about, we value your service and ignore your feedback.
And we do too, right? Deb and I do. We'd love to have that feedback as well for future presentations. So please.
Absolutely. And this is good stuff for you all to take in, as you look at managing partner content programming, what they're interested in. So as we started, working this through with Deb and Paul, as always, we ask a handful of registrant questions when you sign up. And the first is firm size. So Paul, Deb, if you any comments on that, firm sizes? If not, we just for reference.
Yeah, I think overall that really aligns with the client base that we work with. So, I would say those last 3 categories, but when you look at the bell curve, the firms we work with range from, a few attorneys that are, boutique firms that are extremely profitable to 400 attorney firms. But I would say from a bell curve perspective, it really does align. So we're familiar with your audience.
Yeah, our sweet spot is that 25 to 100 when people ask, hey, Jay, what firm sizes come to your stuff? Yeah, yes, they're smaller, they're bigger, but the sweet spot is sort of 25 to 150 or so lawyers.
What's interesting, John, on the tax point of view, really quick, the size doesn't matter, right? Because every firm has the organization type, which we'll get into a little bit later. That's what really is the driver. But the 200 attorney firm that's a partnership, they have the same issues as the 10 firm, the 10 attorney successful partnership. Same concepts, to just maybe not even bigger numbers, right?
Just scaled up a little bit, yeah.
Yep.
Or a lot.
But they might not have the finance department to support that. They have smaller departments to support the firm, so they need more handholding, they need more help. So that kind of just changes the dynamic.
Well, and we're starting to see more fractional, CFOs, fractional COOs. They want that big law expertise, but can't quite afford the big law compensation package that comes with it. And so the fractional. Here you asked us to present this question. And so, Deb, I'm going to ask you, Paul, chime in. Okay, are you surprised? How should a firm organize? And I'm sure there's so many factors that go into that. You're going to tell me it depends.
So I would say, just looking at the data, when the firms we work with, 1/3 are corps. So 2/3, 66% are partnerships. So it really does align to our world. And I think Paul can give some great feedback as it relates to, let's call it, the differences between them and what considerations should be taken.
Right. Yeah. Like what Deb said, the 2/3 of S Corp and C Corps, that's what 1/3 is what we see. And then the remaining parts are partnerships. I always got to ask the question, what's the right entity to be? There's not the right entity. It's being the entity that's right for you and your partners, and then knowing the right proper tax treatment, how each one goes. Like a shareholder in a C Corp, they're live for tax purposes, super simple. That same partner in a partnership, multi-state stuff, a lot of filings, a lot of complexities. There's differences there. And we always say year-end planning, it's easier to run, the firm for the partnership. That finance group may have an easier time at year end versus the C Corp, because the C Corp is really managing their bottom line, because they're going to be tax paying entities. So there's a lot of devils in those details that we'll explore during this hour. But I'm not surprised by that makeup.
Yeah. Uri, consistent with what you're saying in terms of how firms are organized as an entity? So
yeah, I mean, most of the firms that I see, and I'm not exactly sure why. Maybe Paul or Deb know why, but most of the firms I see are LPs, LLCs now. Again, that's in the New York, New Jersey region. But I'll sometimes see some variations.
And there's no perfect right, wrong, perfect compensation system, perfect, partnership agreement. I mean, there's so many factors that go into what's right for your firm at this point in its history, and things should evolve. This was an interesting question. Paul, what do you think of this data?
So it's interesting. We were talking about this earlier. So I think I'm surprised by the 87%. I thought that number
high or low? You think that's a high number or a low number?
I think that's on steroids, that number. Not saying it can't happen, but we were discussing maybe there is a signed agreement for most, but it may not be the currently signed agreement. I was looking to see a number a little bit lower, and depending on the life cycle of the firm, right? We've seen, early generation firms may not have a true robust partnership agreement, but third, fourth, more robust partnership, multi-practice firm, they're going to need their ironclad partnership agreement just to manage its day-to-day business, because they're going to have multiple partners, 20, 30, 40 partners. They really need an ironclad partnership agreement.
Deb, you're surprised to see this, or is this kind of what you might expect?
I think I'm surprised by it being coded as current. I feel as though it's been sitting and collecting dust over the past 20 years. So current might not be the right word.
I get in there with firms. I'm no expert I'm no accountant, but let me see your partnership agreement. And it's amazing how often, it hasn't been reviewed in years. And, we look at it when we join the partnership and want to sign it, and we look at it when we're fighting and we should probably look at it when everybody's cool, calm, collected, and make sure it's accurate, up to date. You know, we're lawyers after all. Uri, are you seeing some sloppiness around partnership agreements from time to time?
Oh yeah. I mean, I also think, I don't know if it's on steroids, but that is a higher number than I usually see. But I do think it's increasing. You know, years ago, I had one of my clients had one of the biggest blowups in New York's history of a law firm fighting, and it's like a divorce. I mean, they were killing each other, spending tons of money litigating. All could have been, at least a lot of it could have been mitigated with a partnership agreement, which they didn't have. I mean, it was really kind of surprising. So this is a great number. And I'll say one last point on this is a self-selective group of high
Yes.
performing firms. So maybe that's why we're above average today. You know, I'll put that out there.
Right, because
Yeah,
I
that
think you've been
agreement's
preaching
really
this for years
important.
and years. So
And
they're
we've
they're
done
they're
some
listening.
programming about what should be in the
Mm,
agreement, what shouldn't be in the
yeah.
agreement, you know, the
Mhm.
basics of buy-in, buy-out, amendments to the agreement. You know, should the compensation model be articulated in that
Mm.
agreement? Should the governance model be articulated in that agreement? I don't know. I like governance by supermajorities, and I see a lot of firms get locked up in these partnership agreements where it's unanimous agreement to do anything.
Mm.
Admit, expel, amend. All of us have to agree. And as we get larger, come on, you're just really locking yourselves into an unworkable agreement. Um, so there we are. And now let's jump right in. We've divided our time today into 4 main topics. And Paul and Deb are telling us that the first topic is the weightiest, the meatiest. So we're going to spend a disproportionate amount of time compared to the other 3 talking about tax optimization strategies. When you registered, a number of you, questions for the guest speakers. Paul and Deb have digested those questions to get a sense of, you know, what's on the minds of the audience and why you're here. We'll talk about operational, charitable contributions, and emerging issues. So let's start with tax strategies. And Uri, this is the point at which you're on, my friend.
Yes, I'm a big fan of paying taxes. You pay what you should, but I'm sure there's a better quote that you only pay what you really should and not what you just do. So, with that, we're going to spend time on some good tax strategies from the trenches, as we like to say. So, Paul and Deb, we're looking forward to seeing how you can keep a little bit more in your hand, a little less in Uncle Sam's hand. So, our first polling question on this topic is, for your capital expenditures, are you taking advantage, or have you planned to do in your firm, taking of the big beautiful bill provisions? I see we're calling it BBB today, of the accelerated depreciation provisions. Is that something you are going to be focusing on at your firm? So who's taking advantage of that? Yes, you are. No, you aren't. Or what's this
Not
accelerated
sure.
depreciation? We're not sure. So
Yes, no, not sure are the options we presented, keeping it simple. And I like to run the voting, having lived in Georgia for many years. And the polls are open, and I like to get about 80% of our participants in before we shut the polls. What do you think, Deb? You think most firms are planning to take advantage of this, or where do you think this crowd's at?
You know, I think a lot of firms do take advantage, but I actually appreciate the not sure response, only because a lot of the things that we will talk about, it depends. It depends on the firm's philosophy on certain things. It depends on where your year is going to come out, and you have to really balance a lot of different things to make a determination really what's best for the firm for that particular year. So I don't think you can always say, yes, for sure, I'm going to do it, or no, I'm definitely not. I think you have to approach each year end differently and think about all the different things that could happen.
Deb, that thought process of thinking if they should take advantage, is that
Mhm.
something that they should have been doing already, or is this something you sort of figure out in the last weeks of the year? How does that work?
I think you should have been thinking about it throughout the year, particularly if you have a large spend, if you have leasehold improvements, you're in a new space and you know you're
Mm-hmm.
putting out millions of dollars with new
Yes.
furniture, leasehold improvements, even new computer equipment. Those are discussions you should have been having throughout the year and
Okay.
pretty much made a decision, but it's still not too late. So there's still
Okay.
another month and a half to make these decisions.
Okay. So a big build out space would definitely make it have a good discussion. Important. What are maybe another trigger or two that would bring that to the top at my next partner meeting?
So, what else should you think about as it relates to, I mean, you should be looking at what is the profitability of the firm, right? A lot of firms have targets. So
Yeah.
you might decide that I don't want this huge expense hitting my P&L this year for whatever reason.
Right.
Or maybe it's the first time the firm has ever had a huge build out. So now I really have to think about what is the philosophy of the partnership? How do I, if I have a departing partner this year, you know, maybe my biggest partner is leaving this year. Now I'm going to spend $5 million and he owns 10% of the firm and he's going to get hit by a large amount, but he's not going to be here to appreciate and spend the time in that new space. You know, is that the way we want to, do we just want to say we're going to get the deduction now and whether you're here to enjoy it or not, it doesn't matter? Or do we really want to think about any of these big expenditures? We want it to be paid for by the people that are going to actually utilize it over the next, you know, leasehold improvements are amortized over 15 years. So over the next 15 years. So those are things to think about as well.
Yeah, I know we're going to get later to some retirement discussions, but that's to your point, Deb. So many firms have different competing interests, some different horizons for partners, right? So to your point, some of them want to invest now. I'm going to be here for the next 30 years. Others are like, wait a second, what are we doing all this investment? I'll be out in 2 or 3 years. Am I getting the same benefit as my partner? So John is having a little technical difficulty, so we'll talk on
this
our
is
slide.
The story. I go to these conferences, and the people at the AV people at the conference center grab my laptop and reset everything.
That's okay, John. We're good because our tax professionals are going to talk about some tax optimization strategies. This is really what everybody's all excited about. So, what is bonus depreciation? But for those of you who don't have it in front of you, which I think is everybody right this second, Section 179 deductions, and then talk to us about PTET or SALT cap workaround. So,
there we go.
Paul or Deb, whoever wants to take these in order. Bonus depreciation, hit us.
Sure. I'll start quickly. Just one quick comment, like what Deb was describing as well. What's good for the firm is what's good for its partners, right? It should never be self-serving. One person gets the chunk of the tax depreciation. It should just be how the firm should be operating, what's best. Second part, I teach classes internally, and it's a little hokey, but I had this little phrase: appreciate what to depreciate. Right? Because there's devils in the details there. It means a lot, right? It can change. You don't have to make the election as you make your purchases, but you just need to have the data to understand. And if you're that C Corp that we talked about, you may want to manage that income down to a very low number, right? It may mean something different than a partner in a partnership. So just understand, again, there's never one answer here, which makes it very interesting for discussion purposes. So bonus depreciation, one big beautiful bill. Before that happened, bonus depreciation was supposed to be 40%. What does that mean? Fixed assets, computers, desks, any capital expenditure you have, leasehold improvements. You normally would what's called purchase it, you would capitalize it and then depreciate it over its useful life. That's general accounting. Bonus depreciation allows you to accelerate those deductions. In 2025, it was 40% as of January 19th. Now it's 100%. So you have options here.
Oh.
What makes it interesting is this 100% by asset class. So there's 3-year, 5-year, 7-year, 15-year assets. You have to elect out of bonus to not take it, right? Otherwise, you're taking it, and you do it by asset class. So you have some room to maneuver around to see where that number lies. It's all based on what the firm's needs are. One thing to note: bonus much different for states. Federal is the bonus depreciation concept. A lot of states decoupled. So you have to see where that falls for your state. But like states like New York, California has a very small amount that they allow. The bonus is unlimited. It's 100% on all your purchases in the calendar year. Okay. Now we have 179, a different animal, same concept, accelerated depreciation. But this, you can take a part of an asset or all of an asset. It's not by class, but you're limited. You're limited to $2.5 million of deductions in the calendar year. Okay. And that's up to purchases of up to 4 million. Once you go over 4 million of asset purchases, it gets decreased dollar for dollar. Some states allow 179, right? So
I would think one of the big areas is technology, right? Where firms are making big outlays into technology, hardware, software contracts, and prepaying or accelerating depreciation on these assets. Isn't that a big area where we're seeing this within
correct.
firm operations?
Correct. Deborah mentioned build outs before. You normally
build outs.
Build outs would probably be your first, if you're doing a build out, if you have new lease space. If not, you're right. Technology, computer upgrades, everything now that's moving towards AI that's going to be in your future seminars, right? Everyone gearing up for that hardware purchases to help them run their firm more optimized and to take advantage of technology. That's going to be a hot area where they may want to accelerate these deductions.
Paul, what about things like dues to associations? I mean, law firms subscribe to a lot of things and pay dues to a lot of organizations. Are there advantages to paying them off year end versus maybe pushing it into the next calendar year?
Sure. So like just general like professional dues.
Bar association dues or the subscription to LexisNexis,
Right. You'd have to manage that, right? You have to see where's the firm going, right? Do we need to generate? Sometimes there's reverse tax planning. We've worked with firms that, they may have a bank covenant that they don't want to take accelerated depreciation. They don't want to make that payment because a lot of firms are cash basis for income tax basis purposes, for tax purposes. So they live and die by January and December, right? So if they can manage not paying that bill, they'll have that dollar more of profit. Or if they're looking to work that profit down, very manageable by accelerating, right? Tax 101 is deferring revenue and accelerating expenses, right? If that's what you want to do. But if you're looking to ramp up your revenue, you may want to do the opposite, right? And we're going to get into some other issues with the big, beautiful bill because there are changes coming down in 26 that affect itemized deductions for individuals.
One thing you should always think about, so pretend that you want to accelerate deduction. So you determine I'm going to pay a couple months of next year's rent in the current year. You just have to remember for budgeting purposes, now I only have 10 months of next year's rent in my budget unless I'm going to continue this. So you really have to think about once you start doing these different expense acceleration techniques, you have to think about how that's going to continue to impact your future budgeting and financial position.
You have to do it every year. You have to do it every year, right?
Yeah, right. The first year you
do 1 month. At the end of the year, they flush out all the accounts and pay the partners. Everyone gets paid, and we start the new year with zero balance, draw on our lines of credit for the first month or two. Is that what do you think of that strategy? A lot of firms use it, empty the coffers, and then draw on a line of credit till we get our, first quarter bills paid.
I honestly don't see that too much or at all. I think most of my firms actually have lines of credits and haven't touched it in a decade. So I think it's there as a safety net, but luckily they don't really need it at all. I think the only firms I really see borrowing on are really the class action firms, which they're funding case costs. So that obviously makes sense. But I don't really, and I don't even see, and I don't even really see, I have firms that pay out the monthly profit every month, and don't leave any for the tail. But I would say 90% of my firms, they're paying out 75% of the profits during the calendar year, especially when I'm talking partnerships. And then the other 25%, they pay it, by 4/15, right? So it's
that's interesting because I run into so many firms, and again, I'm not an accountant, but they start the year with nothing in their bank accounts and draw on that line of credit for a little while. That just seems to be a pretty familiar pattern that I've observed.
It's a slippery slope. right? Once you borrow to pay partners, you need to manage that. It's because you could quickly fall behind the eight ball by not being able to repay that loan. Now you've technically borrowed to pay your partners. You didn't pay them on income. You paid them on cash availability. Now you created a liability going into the new year. So you're already, like you said, John, behind the eight ball.
I could see it's tricky.
Yeah, it gets dicey quickly.
People just seem to want that money at the end of the year. They want the big bonuses. You know, let's clear out the checking accounts and get the partners paid. And they raid their they raid all their, you know. Ari, are you seeing, what do you see any of that stuff going on?
I see thinly capitalized firms, you know, where they go into January, and January is just a tight month, and it just always is. And you know, the accountants can explain it better. You know, nobody likes to pay phantom taxes, income taxes. And so, yeah, they want to take out the cash, but you got to start something in January. And to your point, John, you know, the bills don't get paid on January 1st. They don't even get paid by January 15th. So you do have that first month where you have to cash flow. But law firms historically, certainly the ones today, are pretty thinly capitalized. You know, we used to do survey years ago, you know, how much reserve do you keep over a year? And you know, the average was like, I think it was 2 months of expenses. That's pretty thin, you know, for a business that goes up and down in cash flow. 2 months is not a lot of time.
Yeah, particularly litigation
you know,
firms, you know, on the contingency side. My goodness, you're living dangerously. Yeah.
Sure.
Let's move on here. Anything else to cover here before we move into our other three subject areas we wanted to cover today?
Salt.
Yeah, we didn't touch salt at all.
Salt.
Right. So one of the other items, a big ticket item, like in the big beautiful bill, right? So pro taxpayer, we got bonus depreciation back to 100%. We had the PTET extended now. It was because it was on the cliff, right? It was going to go away. For those that aren't aware, the PTET is the really right now your best chance of getting a state and local tax deduction. What they also gave in 2025 is they increased the SALT cap. The SALT cap, the amount that you can just itemize, is $10,000 in 24. They raised that to $40,000. So great, right? However, for those in high real estate tax states, right, you may eat into that $40,000 very quickly with real estate taxes, along with your state and local income taxes. Okay, so then the question becomes, does PTET, is that still a good thing for my firm? So really quick, C corporation shareholders, unfortunately, PTET is not something for you. It's only for pass-through entity. That's what the PT is in PTET. So it's for our partnerships and S corporations. Okay, and it's still a great bang for your buck because, Uri, I know we talked about this is not just a New York centric, but someone making $500,000, a partner making $500,000, that's where the SALT cap starts to eat away. Anything over $500,000, married filing joint, so that's joint income, you start to lose that $40,000. And if you're in New York City, you're paying a 10% tax. You're paying almost 7% state. You're paying almost 4%. It's almost 11, but for this purpose, 10. Right there's $50,000, and you have 30 grand of property tax. Your state and local is 80,000, but if you didn't do PTET, you're only getting a $40,000 deduction.
Come to Florida. Deb, anything to add?
No, but I mean, your point is good about come to Florida, but you have to think about if you are a partner in a partnership where most of their income is allocated to a tax state like New York, you're still, as a Florida resident, paying tax on whatever 90% of your income, whatever that allocation percentage is. So, you know, I'm rooting for everyone to move to Florida as well. I love it there. But you still end up screwed if you're a partner.
Before we leave this and move on, are you seeing any clawbacks on the PPP loans that everybody, you know, Uri, when we launched this webinar series, that was the hot topic, PPP loans.
It was.
And should we or shouldn't we? And everybody did, just about everybody did. Any auditing, any clawbacks going on PPP loan, you know, loan activities that you guys are seeing?
I haven't seen any in my client base at all.
Yeah, I haven't heard anybody talking about it. Uri, you seeing anything on that, PPP loan clawbacks or audits or anything?
Every once in a while you'll see it in the news, but I have not seen one against a law firm.
Yeah. The employee tax credits too was another one that firms were hesitant to take advantage of, but it was there for you, and legit if you were inclined to go for it.
Right, and I think you used the right word there, John. I think the clawbacks were there were some bad actors out there may have been trying to push their product and there shouldn't have been. But we haven't
Bad
seen
actors grabbing free money, Paul?
it.
I've
Yeah,
never
never,
seen
never,
that
right?
before.
Not in
Never.
Florida.
So no, never. Boca Raton, clean as a whistle. Operational structural issues. We've covered some of this. We have a polling question. Let me see if I can do this right and not whack my technology out again. So we'll launch this. We talked about leases and many of the firms here are probably single office situations, others multiple. Advice around leases. And what do you think we're going to see here? Probably not a fair question. Let me go ahead and share the results and you can talk accordingly. Looks like most firms are pretty well set on the lease front for next year.
Yeah, we had a lot of movement over the past 5 years, which obviously after COVID, it just ended up a lot of leases were up at that point in time, and some people got some good deals at that point in time. But then with everyone coming back to work and people looking for new space, it's getting expensive again. Is what we're seeing.
Of course, the downsizing, the hoteling. We talked a little bit about lawyers working remotely in other states and some of the issues that creates. The partnership agreement updates, we pretty much touched on how important it is to review that document every now and again, make sure it's current, up to date, and the planning stuff for new partners coming in and the retiring partners going out. Deb, any guidance you might offer in this area to our audience?
Sure. So we could start with the lease. I mean, we'll start with leases because there are a few people that are contemplating. So I think it is an important topic. So with all of our clients, whether we're only doing a tax return or we're doing the financial statements and we need it for disclosure, we always want to see leases. But more importantly, if you're thinking about entering into a new lease before you finalize, not after, but before, we really want to take a read through it because we want to make sure that it's belt and suspenders so that you don't have any unexpected tax consequences. So basically, a lot of leases these days have tenant improvement allowances. And what that means is that they'll pay up to $2 million of the improvements that they're going to make on the space. But it depends on the terms of the lease as to how that really should be treated. So if you have a lease that is 15 years and it has a renewal option that's fair market value, then you meet what's called these safe harbor provisions because it's considered a short-term lease. And what that means is that any cash that's received or treated as a rent reduction and used for leasehold improvements are not income to the law firm. Conversely, which is really strange, but if you're over that 15 years, then any of those reimbursements you receive are income to the firm, which in reality should end up washing out. But the issue is if it overlaps a year and you don't get that reimbursement until the next year, all of a sudden you're taking an expense in one year and then you're picking up the income in the other year and you're not matching. So that's really something that we want to be able to see those terms in your lease. And it's possible that you could just add, or we're not attorneys, we're not going to give you the exact wording, but it's a negotiation that you can have with the landlord and put certain wording into the agreement that will, as I mentioned before, belt and suspended the agreement so that they're the assets of the landlord and they're not yours, and then you're not subject to this income pickup.
And personal guarantees, of course, are out. That they're a thing of the past, right? Generally, we don't see personal guarantees on leases.
On the leases, I don't see them anymore.
I don't see them anymore. It used to be a big deal. That's what's going to trigger a strategic planning discussion. We all have to personally guarantee the lease for the office space.
How many firms closed when their lease came up? I mean, it was ridiculous.
We talked about planning around retirements, admissions, unfunded retirement obligations. Boy, I see that as a killer for a lot of smaller and mid-sized law firms, paying out the founding partners big money that the firm may or may not be in a position to handle. Any comments on that, Paul? Deb?
Sure, just
I'll start with you,
general,
Paul.
like what we were talking about earlier with capitalization, right, of the firm, right? So that all goes into the same bucket, right? So how do you handle your new partners? How do you handle your departing partners, right? You really want to have something in the partnership agreement that speaks to the departing partners when their capital gets paid out. Is it just capital, or are they getting an earnout, like you said? Is it the founding partner that's going to get in perpetuity? It's probably not what's best for the firm, right? So you want to have some type of guardrails in place that not just protect the rainmaker. When I said a rainmaker, protect the firm from a rainmaker raiding the coffers, as you said earlier, but you also want to protect the firm against any type of defection, right? So you want to have either a dollar limit on how much you're paying out in capital per year for both an individual and for the firm. Like, the firm shouldn't be paying X% out in capital if there happens to be someone that they need to pay out or a group that leaves. There should be something that says, wait, hold it, we hit that limit, that limit's triggered, it's going to be a 4-year payout, whatever that term is. It shouldn't be within 30 days. Right?
Are you
Paul,
seeing any trending around mandatory de-equitization provisions in partnership agreements? Deb?
I'm not seeing that, but I am a proponent of there being some type of either mandatory retirement age or mandatory handing over your book of business, transitioning a book of business, because how are you going to have a future of a firm without doing that? So unless you are somehow forced to do it within the partnership agreement, some firms, I don't know, they just allow people to stay for, I mean, they're great. I mean, obviously great attorneys, they're doing a great job for the firm, but they're not doing a great job for the firm, because how is the firm going to continue without bringing up the lower, the lower level people and the young people?
I agree. And I say, we got to look to compensation models too, that encourage the hoarding and control as opposed to the transition, and cross-selling, and opening up these client relationships to become more institutional and less dependent on the individual. And so often the comp system, in the spirit of rewarding the rainmakers, big origination credit for life. I don't like that's a killer too, origination credit for life, I think.
And those
Comments
those retired partner payouts, I mean, I am seeing in the size firms that we're working with that those are going away. So they're actually, if you're a partner as of 1/1/25, okay, you'll continue, but anyone that's made partner after that, you're not getting this benefit. It's just it's very difficult for firms to have to be able to fund that going forward.
So we've got 20 minutes, and
it's not all about
Uri's baton here.
So it's not all about keeping it directly. So let's talk about charitable contributions, group.
Yep. So this is a adverse Big Beautiful Bill Act component going into 26. So
okay.
Well, I guess Uri, you're gonna have someone's gonna have the polling question first.
Well, yeah. Well, I guess your question, which you gave us, this question belies that there's a reason for it. So will you or your firm be front loading charitable contributions by the end of this year? So will your firm be front loading, meaning wanting to do it in the end of December 25 and not in 26, front loading it, right, Paul?
Correct, and it could be for a series of years. You want it, the concept is you want to get the deduction this year because it may be worth less next year.
So why might that be? And I think that's your point on the Big Beautiful Bill. Something happened to make 25 special in this regards, and what's that?
Correct. So for 25, the general charitable contribution rules for both corporations are allowed to deduct up to 10% of their income for charitable contributions. And then individuals get up to a 60% deduction of their income, right? Going forward, 26, there's now floors and a separate deduction limitation. So let's do the floor first. The floor for corporations The first 1% is the floor, and then you're capped at 10%. So there's two, you're kind of bookend here. So
Okay.
you're going to get less of a deduction if you're a C Corp.
Mhm.
For individuals, the floor is 0.5% of your income. So a quick way of
Okay.
looking at it, someone making $20 million, it's $100,000 that you're losing the benefit on, right? And this is a big end. If you're at the top rate next year, 37%, you're only getting a 35% deduction. So your deduction is worth less next year than it is worth this year. So we see.
And is that only at the top rate, Paul? Is that only at the top rate?
It's only the top rate. It's only when you're at the top rate. But top rate for, top rate you're getting at pretty quickly, right?
Yeah.
I mentioned 20 million. The top rate comes in at, a bit over $500,000 married file joint.
Sure.
You're going to start shedding it.
Comments on the polling results before I drop them and go back to the PowerPoint? Any? We're not seeing it.
I think it makes sense. Not sure or no, because I don't, we're now advising everyone as to what's changed, right? So maybe now they'll think about possibly taking that under consideration.
Exactly. Okay. And again, because most firms are cash basis, right? You have the ability to plan right now to front load, bunch, however you want to term it, to get those deductions in this year, because again, they're just worth more in 25.
Okay.
Thank you. And is there an itemized limitation you were talking about that's capped at that 10%?
So for C corporations, that's always been, the cap has always been 10%, and you get to carry that forward for 5 years, right?
Okay.
But again, C corporation law firms, they tend not to have a lot of taxable income, right? Because they're distributing out, they're paying out shareholder salaries at the end of the year, because the corporation pays a tax. So you don't want to have to pay the tax, and then you get a double taxation on a dividend. So we normally see our C corporations really manage that income down to a negligible amount. So that 10% becomes problematic if the firms just may have to be charitably inclined to certain organizations just to keep their status in the community, right? So corporations get somewhat harmed that way, because even though they get a 5-year carry forward, a lot that 5th year, it just falls off the table and they don't get to take it.
Anything else on charity? We're looking at T-minus 15 minutes, and we're going to talk about emerging issues next. Any other comment around charitable contributions?
No.
Okay, move on. That was pretty straightforward. And emerging issues, and boy, we could talk about a lot of stuff here. Our polling question, hang on, I jumped ahead, is regarding litigation funding. We're seeing that seems to be a trend more and more. And any predictions you all might offer? You think firms on this call are using it, Deb?
I think if there's a class action firm on this call, then the answer may be yes, but if not, then probably no.
Okay. Paul?
Yeah, I would go one step further, not just class action, but any real litigation shop, right? Not necessarily class action, but anyone's doing litigation, that there's a pipeline of litigation in the works versus they're churning out invoices, they're getting paid monthly. That's where I would see a higher probability that they're investigating litigation funding. But again, proportionally.
It seems like we don't have class actions. Most of our firms
John,
are.
can you share the results? John, can
you
you share the results?
Close poll, share, hang on, tools, polls. I thought I shared them now. Okay, share again. Can y'all see that? Has your firm considered litigation funding? 90% say no. Only 5% are looking into it. So it doesn't seem to be a hot thing here. We were reading an article that dropped earlier this week about McDermott, big Chicago firm looking at private equity. Uri and I kicked that around, and what's going on out in Utah and Arizona with alternative business structures. And it just doesn't seem to be catching fire like we thought it would. The private equity investing in cases, investing in law firms, doesn't seem to be happening.
Only time will tell.
prevalent, a shameless plug here, like we said earlier, for Anchin, like accounting firms, law firms, kind of running the same manner, right, with ownership being that way. There's different ways to get capital into the firm, right? So just really quick, I know there's not a lot of audience here for it, but that litigation funding, it was a big deal in the proposed big beautiful bill, because it would have basically decimated that business sector. They were going to tax this at 40.8% as an excise tax, not even income tax, and then it would make the firm that received the proceeds that they're paying back, they would make that firm withhold half of that, considering it all being profit. So it was a major component in the bill, and it's gonna get a lot more bandwidth maybe as the years go on. But as firms look for alternatives to funding, right? Right, John, you were talking about capital. Do I draw down my line of credit? Oh, hey, I got a company out here that's going to lend me money based on my cases. That sounds interesting too, but they tend to be a bit more expensive than the traditional financing.
We've been doing some programming, about improving profitability. Everyone's interested in improving profitability, and what strategy is your firm going to deploy to achieve that? We're going to raise rates. We're going to raise rates. That's what we're going to do. And they've been getting away with that for quite a while. And with AI coming into play and the pressure on billable hours, is the billable hour model starting to maybe come unraveled a little bit as we look at contingency, flat fee, subscription-based fee arrangements. What are you seeing out there, Deb, in terms of billing, alternative fees, alternative billing, and that sort of thing?
We do see some alternative fee arrangements, but it will be interesting to see what really is going to transpire going forward, because I still think no one really knows how to deal with, I'm using AI to do first year associates work, and how am I billing that work? So that's still a conversation that's being had. And especially in this population of firms, I really don't think anyone's really figured it out yet.
I think people are interested, a little skeptical, as lawyers tend to be, and we see these highly publicized malpractice events that really spooks lawyers. And if we're not using these tools, we won't have this problem. But Uri, we've talked about insuring around AI, and what are you seeing as policies are renewing and things around litigation involving AI blunders?
Yeah, I think, in fact, just sneak peek, I'm predicting next year we're going to have our first big malpractice blow up, and the law firm's going to say, yeah, but I got it from AI. That's my prediction for next year, John. We have not seen that. So far it's sort of like these silly, it's not such a joke for the court, wasting the court's time, but the hallucinations, AI's coming up with fake cases, they get exposed, and it's embarrassing. Most of our clients are avoiding it, luckily, for a lot of reasons, but one of them is they don't want to be embarrassed. Gosh, how do you explain to your client how we didn't check our work? I mean, it comes down to that. So a lot of people are paying attention to it. In terms of profitability, I think firms have a lot to look out for. Deb, you alluded to it, just tacking on to what you said, which is a lot of clients are not willing to pay for first year stuff. I had a client tell me today, they just got a memo from one of their largest clients that said, and this is a litigation firm, they just said for litigation summaries, for deposition and understandings, all these kinds of basic services they used to provide for this firm, the client said, we are no longer paying for it. You must use AI to do it. And the client knows the gig's up. Client knows you can put it into ChatGPT and get something in 15 minutes. They're not paying for it anymore. So yeah, looking out for that. That's for sure.
Mm-hmm.
Yeah, there's a lot of, we covered this at our fall program in Chicago, and had a really fascinating discussion around training young lawyers. Do we need paralegals first, second, third years? How are they going to learn to do the basics if they're relying on machines and such? Let me ask you one other question that keeps popping up on our listserv elsewhere is the technology fees. Charging a percentage, charging a fee for technology. We used to pass through the photocopies and the long distance phone calls and the faxes. Those were nice little profit centers in most law firms. But trying to recapture some of this investment in technology through, assessments. You seeing much of that? I'll toss that around the room.
I'm seeing a
Starting
little
with Deb,
adoption of
ladies
that,
first.
but I would love consistency across all law firms, so that it would become the norm, because then it wouldn't be as controversial, because I think to some clients it is controversial to be paying for, this is your internal expense, why are we paying for your technology fee? But that's what's required in order to provide these services, and I think it's becoming more and more commonplace over time.
Yeah,
I think firms are
I
trying to
agree.
recapture that expense somehow. And, Paul, what do you see?
Just to Uri was talking about, increasing profit margins, right? The road to profitability. There's going to be down the road, right? I'm not an economist, but there's going to be a major spend on technology that we talked about earlier, right? So it's not just the maintenance technology that law firms are using on a day-to-day basis. It's going to be the investment that they need to be competitive. And I dare to draw a metric that, John, once your AI group grows and grows, right? I'm sure that's when also firms will have a set policy on actually how they're using it. I still think people are still on the sidelines a little bit. They're using it for the low-lying fruit stuff, not necessarily to practice law, but like that organizing data. Put that into ChatGPT, put that into Copilot. Right. I'm not paying an associate salary for that. That's where it's going to happen. But firms have to invest in the technology to do that. You're not just using the general version of ChatGPT, and you have infrastructure, personnel, and technology. So I think the only way to kind of account for that, to counter effect the billable dollar, is going to be these alternative fee arrangements plus a technology charge, right? Because there's got to be some way to recoup these costs. And there's going to be big spends.
It's been suggested there's some state bar ethical considerations around these tack-on fees for technology. Massachusetts, I understand, I haven't researched it, has a prohibition that you can't do that. So I don't know. I think it's worth looking into. And I think clients more and more will expect that. They want to see their law firm investing in technology and training and all this good stuff. And, we're advocating, training, policy, lean in. Your people are using this. Teach them to use it responsibly, ethically. The prompting is really, really important. Mm-hmm. And, what are you working with? Copilot, CoCounsel, Harvey, Claude, Perplexity. I mean, where's it all going? And I think we're just in the infancy here, in the embryonic stages of the impact this is going to have on the profession. I really do. And some firms are going to get ahead and some firms are going to fall behind. Mm-hmm. And where do you want to be on that adoption curve? Anything else? Emerging issues we haven't yet talked about before we move toward closing things out? Paul?
I think the only other item was were these state filing challenges, right? And it's not just the filings. It's really, we were talking earlier about we have an audience across the country, right? Which is great. And if I'm sitting in, Ohio, I may not think that I have any other obligation than Ohio.
Come to Florida, Ohio people.
Same thing with Florida. I'll even pick on Florida. Just because you're in Florida, John, I've seen you in New York.
Yeah, you have.
So just for firms to understand, even if you're a single office, no matter where you are, you should be speaking to your tax professionals on, are you compliant? And when I mean compliant, I'm less concerned about compliant versus what pass-through entities could be missing out on. Their owners could be actually missing out on real tax dollars, because I'll say it quickly, for people that pay taxes, not in Florida, but if you're in a tax state, right, like New York, New York City, New Jersey, Connecticut, any other tax state, you get a credit, right, for taxes paid in other states. So it's normally not a double tax. It becomes a double tax if you never filed in a state that you should have been filing because you didn't know. And then the state says, hey, I think I know you should have been filing here. You had a remote employee here. You had something going on here that we look at. And now it's past the statute of limitations. Now you've lost the ability to claim that credit. And secondarily, for the larger firms, you got 50 partners, 60 partners. Now you have to go in front of your partner group saying, good news, we got it under the statute, but everyone's going to file amended returns. Yes. And you got to file in this new state now. It's not a good look. So just be aware of those items.
let me, I gotta move things on. We're at 2 minutes above the hour, and we like to dispense. Our puppy dog has some advice to talk to your advisors here at year end. Keep an eye on that partnership agreement, review it every couple of years at minimum, tweak it as appropriate so it's an accurate reflection of how you do things. Start this planning process, retirement process early. I think especially on the client succession side of it, the charitable policies, and sign up for our conference. I had to put that in there too, right, Paul? And there are advantages to sign up before year end? You get, accelerate that expense.
I heard discount. I heard discount. Was there a discount in there?
I didn't say that. I didn't say discount.
Early bird. Early bird.
Early. No, we will do a discount. We're going to do a soft opening year end because we get people calling us, even if we're not open for registration. They're coming and hey, can we go ahead and pay for this in advance? And it's like, sure, yeah, I'll take it. Paul, thank you. Deb, thank you. Appreciate your participation in our program today very much. And we will be following up with our attendees and links to reach out to Paul and Deb if you want to continue the conversation as well. We have our seminar coming up. 9 Sales been writing up recaps. We'll let you know more about our MPF AI community if you haven't yet checked it out. Contact information. This will all be in the follow-up. Uri, what you got to take us home?
Great conversation. I mean, this was, we had some really good attendees today. I'm sure they were following this closely. Paul and Deb, thank you for your agreeing to take any follow-up questions. People can contact you directly. Very technical today, very practical, and very useful. Thank you.
Thank you, guys. Have a great rest of the week. We'll see you next month. Have a good Thanksgiving to our U.S. friends.
Happy Thanksgiving.